You have some great calls, some important calls. I wonder, will anything change depending on what happens in Ukraine?
Good morning, Francine. Well, clearly, there's a huge focus on the Ukraine situation, and understandably, because the results of any further escalation can be very unpredictable. And clearly, it's going to have, as it already is, quite a big effect on energy prices, which, again, is sort of feeding into this sort of inflation story, which the markets are so focused on. We're seeing higher volatility, as you were describing earlier, but fundamentally, the markets have got to grapple with that uncertainty and also this trade-off between the urgency to raise interest rates and what the effect of that is ultimately going to be on growth. Our feeling is that we're still going to see economic activity continuing through the course of this year. So the pullback in markets is really about adjustment in the cost of capital. It's not really going to turn into a bear market that's reflective of a recession.
Peter, do you think the Fed starts to readjust their view on rate hikes in light of these geopolitics?
No, I don't think so. I think they've got to keep very much a focus on the tightness of the labour market, on inflationary expectations, of course, and whether longer-term inflation expectations are being impacted by what we're seeing in terms of energy and other costs. They really have to keep focus on that to maintain credibility and a belief that they're really in control of the situation. And unless those geopolitical tensions really have a big impact on consumer confidence and growth, I think that they'll continue to focus really on maintaining this gradual approach to tightening policy to slow down inflation without hopefully damaging economic prospects.
Peter, I know Goldman Sachs has one of the boldest calls when it comes to Fed hiking this year. What does it mean where you want to be invested in equities?
Well, I would say once again that we need to put this in some context. The markets have already absorbed a huge change in expectations about where interest rates are going and how quickly. Remember, just as recently as June of last year, the markets were pricing no rate rises this year and perhaps two towards the end of next year. Now we're looking at 7 rate rises this year and a few more next year. Overall, markets have held up quite well on the back of that shift, largely because nominal GDP is still growing, and that's ultimately where equities are making a claim. So I feel that the movements we've seen have been quite rational. The things that have been hit most were the things that were most expensive, the longest duration. They're the things most sensitive to this change in the cost of capital. We've been arguing for quite some time that these inflections towards higher inflation expectations and interest rates really support the deep value areas of the market, commodity and energy related sectors in particular, where we have a secular bullish view, but also things like banks, resources as well. So I think that those things still have to benefit, but ultimately I think we're moving into a cycle that's going to be much more alpha orientated, much more about relative winners and losers within and across sectors, and margins are really going to be key to that.